The IRS changed the rules for 2026, and ignoring these limits will bite your very first January paycheck. Today, I will show you the escape map for 2026, covering brackets, deductions, and the enemy underwithholding. Most taxpayers will see thresholds move with inflation, and 2026 also reflects One Big Beautiful Bill Act amendments baked into the system. Ignoring these new 2026 thresholds creates underwithholding, surprise tax bills, and avoidable penalties at your next filing time. Your paycheck withholding or quarterly estimated taxes must match your real income pattern to protect your cash flow year-round. Without a simple 2026 plan, you can overpay all year or underpay and face heavy interest and penalties. You will receive a clean checklist of the 2026 brackets for every status and a practical action plan. This guide gives you clarity and control over your taxes in 2026, and this is the tax borders. The federal tax landscape reflects automatic inflation indexing, plus major changes written into law during the last legislative cycle. The IRS enforcement model relies heavily on automated matching, and underwithholding is where the most painful tax surprises begin. You must understand that the standard deduction was adjusted again for 2026 and impacts nearly every American filer. Have you considered that 2026 returns are filed in 2027? So your paycheck strategy matters right now? If you hold investments, capital gains thresholds also changed for 2026 and can shift your final tax outcome. Taxpayers should treat these brackets like a planning map because the real enemy is underwithholding and the penalties triggered. Every dollar of taxable income moves through marginal brackets, so timing and withholding drive your final year-end cash result. The 2026 tax year is the perfect moment to update your withholdings using these newly released federal thresholds. The first technical pillar is the 7 marginal tax rates, which remain 10, 12, 22, 24, 32, 35, and 37%. The initial 10% tier is a thin inflation buffer that can disappear fast as your income grows. The O-B-B adjustments and inflation indexing move these thresholds upward to reduce bracket creep for many taxpayers. Married couples get an initial $24,800 shield, and only the dollars above it move into 12%. Moving into the 12% bracket starts a gradual climb that many taxpayers ignore until their withholding falls behind. This 12% zone acts like a buffer for many households before the jump to 22% changes the math. Single filers pay 12% up to $50,400, and only the dollars above that start being taxed at 22%. For married couples, the 12% range runs up to $100,800 of taxable income. The 22% bracket is where many working families land, and the marginal rate jump can expose weak withholding. In practice, this jump is a primary cause of surprise balances due when withholding was set and forgotten. For single filers, the 22% range begins immediately after $50,400 of taxable income. Married couples must watch the $100,800 mark to ensure their employer is withholding enough for the year. Failing to track taxable income correctly often leads to drifting into dangerous underwithholding territory without you noticing. High earners must understand the 24% tier because small timing decisions can change your withholding accuracy significantly. The 24% bracket is a pivot point where proactive planning becomes the difference between control and surprise. For singles, this range ends at $201,775 before the next bracket begins. Married couples hit the 32% zone at $403,550, where withholding errors get expensive. The 32% bracket represents a meaningful slice of your income, so clean tracking matters more than motivation. Now the 35% bracket is often overlooked, but it is vital for avoiding expensive, miscalculated withholding for executives. Singles hit this high tier at $256,225, a level where timing deductions becomes a precision tool. Reaching the top 37% rate is a signal to use tax-advantaged accounts, charitable strategies, and deliberate income timing. For married filing jointly, the 37% bracket starts when your taxable income exceeds $768,700. The standard deduction for 2026 is $16,100 for singles, serving as your first tax shield. Married couples can claim $32,200 as a deduction, significantly lowering the base for their initial taxes. The O-B-B-B Act introduced a temporary $6,000 bonus deduction for seniors over the age of 65 through 2028. This senior deduction is per person, and it phases out above 75,000 single or 150,000 joint income levels. The second pillar focuses on long-term capital gains, which are one of the most powerful tools for tax-efficient investing. Long-term gains apply when you hold assets for more than one full year before you decide to sell. The 0% rate on capital gains can apply when taxable income stays below $49,450 for many single filers. Married couples can pay zero federal tax on long-term gains if taxable income remains below $98,900. Wealth planning sometimes uses gain harvesting to reset your basis while staying inside the 0% threshold. For those in the 15% gain zone, the limits extend well into the six figures and planning becomes a calendar game. Anything above the maximum 15% threshold is subject to the maximum 20% long-term capital gains rate in 2026. Controlling the timing of your gains is essential to ensure you do not create underwithholding late in the year. The third pillar is your earned income structure, including wages, self-employment income, and your various business profit flows. Americans living abroad must align U.S. filings with international treaties rather than relying on common and dangerous internet myths. You must maintain a clear paper trail for every deduction, because consistent documentation resolves most IRS issues faster. The alternative minimum tax still surprises high earners, especially with specific preference items and poor income timing decisions. For 2026, the AMT exemption amount for singles is $90,100, and it begins phasing out at $500,000. Married couples see an AMT exemption of $140,200, and the phase-out begins at $1 million. Self-employed taxpayers must also factor in the 15.3% tax with Social Security and Medicare components. In 2026, the Social Security wage base is $184,500, while Medicare remains uncapped. If you run an S-corporation, reasonable compensation and clean reporting matter more than clever stories told by amateurs. This intersection of brackets and reporting is where underwithholding quietly grows into expensive penalties and very stressful letters. Can you afford to ignore these technical details when a small mistake creates a large year-end tax balance? Imagine John, who earns $80,000 on wages, facing a withholding trap if he never updates his W-4 form. Underwithholding is invisible until the bill arrives, and that is why John can feel shocked, even in the 22% bracket. Imagine Maria and David filing jointly at $180,000, where one bonus check breaks their withholding accuracy. Imagine Keisha as head of household at $120,000, where 24% appears fast if credits shift. Imagine Alex the freelancer at $120,000 profit, where income tax plus self-employment tax makes underwithholding common. Imagine Sarah, a U.S. taxpayer in Europe, where the wrong forms create double taxation and massive cash flow damage. Real estate investors selling property in 2026 must model depreciation, recapture, and timing beyond simple capital gains. Short-term trading gains are taxed at ordinary income rates, making your bracket more important than any market headlines. Crypto holders must report transactions accurately because Form 1099-DA reporting and automated matching raise notice risk. Business owners paying contractors must issue correct 1099 forms and reconcile totals to avoid expensive mismatch notices later. Is your current record-keeping strong enough to stop underwithholding before it becomes penalties and high interest charges? You can avoid most surprises by standardizing your records and using consistent bookkeeping from January through December every year. Reconcile your bank and card statements monthly so every transaction is categorized and supported for your tax return. Separate your personal and business spending to protect your audit defensibility, and keep your profit numbers clean and clear. Keep a digital evidence folder for key deductions, receipts, and contracts using a very consistent and simple naming system. Automate your withholding reviews or quarterly estimated payments so you do not drift into dangerous underpayment penalty territory. If you aim for a safe harbor, you can often avoid penalties by paying enough during the year through withholding or estimates. Use retirement accounts and pre-tax benefits to reduce your taxable income and potentially keep yourself in a lower bracket. Monitor your adjusted gross income to avoid phase-outs that can quietly raise your effective tax rate without you noticing. Proactive planning is the only way you keep more of your hard-earned money during the 2026 year. First, diagnose your starting point by projecting your taxable income using the new standard deduction and federal bracket ranges. Take 10 minutes to run a quick projection before the next paycheck cycle locks in your underwithholding error again. Second, decide the right tool for your situation. W-4 adjustment, estimated taxes, or a combination of both methods. Third, execute the plan by updating your payroll withholding and setting calendar reminders for all your quarterly payment dates. Fourth, document your assumptions and keep support so you can explain the numbers if you receive an IRS letter. Finally, monitor your results quarterly and adjust as the year evolves because income never arrives in a perfectly even pattern. You now know the 7 marginal brackets, the standard deduction status, and the critical capital gains thresholds for this year. Take action by testing your income against these thresholds, updating your withholding, and getting help if your situation is complex. Please subscribe to Tax Borders, like this video, and comment your filing status to join our wealth preservation community.